Today, I'm going to explain why cash is only king if it's used for emergencies or short-term funding needs. It's never wise to sit on cash in your home or low-interest bank account if you're planning on parking the money there, other than for a 3 to 6 month emergency cushion, or you're going to soon make a purchase and need the cash in the short term. Inflation erodes the value of the dollar 3 to 4% every year. So in 10 years, your dollar will have lost 30 to 40% in value. The idea is to outpace the rate of inflation after taxes, and the only way to do that is to invest wisely in financial assets, like individual stocks, bonds, or managed funds like mutual funds or ETFs. Even if you're comfortable in investing in hard assets like real estate or precious metals, or the funds that invest in them, they can be useful as a smaller portion of your portfolio to hedge against inflation. Oftentimes, banks will pay nominal, very low interest rates, which are much less than traditional money market funds. Banks are in the business of taking in deposits, paying as little on those deposits, and then lending out money to borrowers for auto loans, mortgages, or consumer loans. Depositors' accounts are insured at the banks, which is why people park their money there. But you have protections as well for parking your money in brokerage accounts. For example, the Securities Investor Protection Corporation, SIPC, serves to safeguard investors. SIPC coverage insures people for up to a limit of $500,000 in cash and securities per account. SIPC protections also include up to $250,000 in cash coverage. The total amount of SIPC coverage is $500,000. Thus, if you have $500,000 in securities and $250,000 in cash, that entire amount may not be covered. However, there are circumstances in which investors are covered for more than $500,000. This happens primarily when investors have multiple accounts of different types. For instance, if you have a traditional individual retirement account, or IRA, and a Roth IRA at the same brokerage, the SIPC will insure them separately. Thus, you will be insured up to $1 million between the two accounts. Of course, SIPC insurance only comes into play under circumstances in which the SIPC must intervene. This happens when it receives a referral from regulatory agencies such as the Securities and Exchange Commission, or SEC, or the Financial Industry Regulatory Agency, or FINRA. If a broker-dealer fails and customers have lost securities and/or cash, the liquidation process will begin. So in summary, cash is only king when you need it for short-term use or emergency purposes. Wealth is created by not losing money, and holding cash is losing money at the rate of inflation. If you like this video, please hit the like button and subscribe to our channel.